Welcome to Honest Money, your best guide to financial freedom. I'm Warren Ingram, the author of a few best-selling books, and I'm also an award-winning financial planner, and I've helped thousands of people on their journey to financial freedom. I'm not here to tell you what to do, but I am here to share my experience and the best ideas that I've learned, and I hope these ideas help you on your journey to financial freedom. Welcome to Honest Money. This is one of those episodes where I'm always a little bit nervous because I'm talking to one of South Africa's personal finance gurus, and I mustn't make mistakes and make an idiot of myself here. So I'm really privileged to be joined by Maya Fisher-French. So for those few people in South Africa who don't know Maya, she's famous as Maya on Money. She's been on TV, she's been on radio, she's written books, and her book is called Money Questions Answered. And she really is one of South Africa's personal finance gurus. So I'm really chuffed to have you on the show, Maya. Thanks so much for joining us.
Well, it's great, Warren. You and I have done a podcast together before on my channel, so it's great to reciprocate and be chatting to you on Honest Money.
So I mean, we're in a world now where we're worrying about inflation. You know, the cost of living is going up, and one of the things that is affected by inflation, or maybe that also affects inflation, is the cost of our money. It's the interest that we're charged when we have debt, or it's the interest that we earn when we actually are lucky enough to have money on deposit. And I thought it's a really nice idea to kind of talk about this and explain it a bit more, because there's some really big questions that need to be answered, but there are lots of really practical day-to-day issues as well around money. And you know, you're at the front line of this and getting lots of questions from people about what goes on. So I thought maybe just to start, you know, when we talk about interest rates, what are we actually talking about when they say, well, the interest rate's gone up? What does it mean for me as someone who has debt?
Absolutely. So, you know, it's probably important to understand that why we have interest rates. So obviously interest rates is, well, I want to borrow money from you and I want to be paid for the rent of that money, right? That's kind of the thing. You know, I could have the money in my bank account, but if I'm going to lend it to you, I'm going to want to be paid for, you know, for the use of that money. So that's kind of the basic principle of an interest rate. But in the middle of this, you have the bank. And the bank is not only just the FNBs and ABSAs of this world, but it's also the government, the central bank, the Reserve Bank. And they use interest rates to control inflation in South Africa. So this is why when the inflation rate goes up, one of the ways, of course, to control inflation, the prices of things going up, is to say, well, let's make borrowing money more expensive so that people can't just go and spend on their credit cards and keep pushing up prices. So it dampens demand. It's a very blunt instrument. We can have debates for hours on end whether this is that, how effective it is in controlling interest rates. But when we see inflation numbers go up, Warren, we know that the Reserve Bank is going to increase what we call the repo rate. And this is the rate at which the central bank lends money to the retail banks. And this is the way that they kind of control, you know, interest rates overall. So it's a very sort of simplistic explanation, but the banks, as the Reserve Bank is the lender of last resort. So the banks, basically there's a link between the price that the retail bank will lend money to you versus what the Reserve Bank will lend to the banks. And so repo rate is the rate set by the Reserve Bank. And then we have this thing called the prime interest rate. And always, you know, people often, it's quite interesting, the word prime. So what does prime interest rate actually mean? And if you think about it, if you buy a prime piece of beef, it's like the best quality beef, okay? And that's actually what the prime rate is. The prime rate is the rate that, it's almost not a risk-free rate, but it's a rate that a bank would give their best customers. So kind of, they say that's the rate that if you're a really good customer, that's the prime, we'll give you a prime rate. So that's kind of the philosophy behind it. But over the years, and I think it was actually under Mboweni when he was Reserve Bank governor, not finance minister, but Reserve Bank governor, that he actually set a direct link between the repo rate and prime rate, I think of 350 points. So we know that whenever they move the repo rate, we know that the prime rate that the banks will set will be 350 basis above that. And Warren, the biggest thing I always get when people hear this is they say, oh, the banks are in collusion. No, this is actually a fixed way, a mechanism of working interest rates in South Africa. So the prime rate will always be 350 points above repo rate. But that is not necessarily the rate at which they will lend to you, because you could be a even better than prime customer, or you could be a worse than prime customer. So for me, it's very important just to understand prime is simply a benchmark. It's simply a way for the Reserve Bank through the repo rate to kind of control interest rates in South Africa. So I hope that kind of sets the scene. It's a little bit complicated, trying to simplify it, but that's pretty much in a nutshell.
Yeah. I think you explained it beautifully, because when we look at this, we're always so skeptical and cynical of the banks and how things work that we're looking for the angle. What are they doing to us? And so if it is regulated like that, as you say, it's not a forced lending rate to us. It's the indicator. And always interesting for me to look at how many people are charged prime plus, and especially on things like cars. The moment you want to borrow money to buy a car, banks say, sure, no problem. It's prime plus 5 or prime plus 6, and we'll give it to you for the next 20 years. And, you're going to be absolutely way poorer than you were when you started. So it is really important to understand that link and then to know that if you are a good customer for a bank and they say to you, we're prepared to lend you money at prime -1, the chances are you probably don't need to borrow the money, because you're such a low risk to the bank that you've got all these assets already. So, banks, when you say a good customer, I think for a client, it's usually people that desperately need to borrow money. Those are the ones that the banks would think are maybe more risky. And so they're going to charge you a higher interest rate. And it's not personal. It's just them saying that maybe, they need to be rewarded for taking more risk by lending to someone who they believe is more risky. So they'll charge you a higher interest rate and hope to compensate themselves if something goes wrong with the loan. So I like that explanation. Thanks, Maya.
So I was going to say, just probably important just to note that there are still caps on how much a bank can lend you. That is dictated under the National Credit Act. Not how much they can lend you, but what rate they can charge you. So those are capped. So for example, on your personal loan, it cannot be more than 21 percentage points above the repo rate. Your credit card cannot be more than 14 percentage points above repo rate. So all of them are, at least from that perspective, there is some kind of control. And unless you go, of course, into the informal market, then it becomes another whole ball game.
And informal markets are nice way of saying loan sharks and money sharks. So just be careful there that you're not, if you're sitting with a bank and you've got a personal loan and they're charging you 40% interest, you need to know that that's not right. You actually are protected from that.
Absolutely.
So we were talking before the show about some of the questions that you get from people saying, banks just, interest rates gone up and the banks just charged me twice this month. I'd love for you to explain that.
So this is actually something that I picked up. I think people would say, where do you get your stories from? I said, well, actually from my readers, because they email me. And it was interesting, because what happens when interest rates go up, it's very important to understand this. And I think we've been in the cycle of decreasing interest rates, so people haven't noticed. But now we're in an increasing interest rate environment. So what happens is that the day that the Reserve Bank announces, it's always on a Thursday, the Monetary Policy Committee announces an increase in the interest rate. The banks have to immediately, of course, adjust the prime interest rate. So your contract with them will be linked to prime, probably. So you may be at one, maybe your home loans at prime or one above prime, for example. On that day that it's announced, automatically all the interest rates at the banks increase. But they only increase, obviously, from that day onwards. So say if it's on the 20th of the month, it's only the last 10 days of the month that you will actually have that increase, because interest rates are calculated daily when you borrow money. It's calculated daily, so it's only on those last 10 days. So maybe your mortgage goes up by, you notice your mortgage going up by 200 Rand. But the following month, of course, you've got the full month's effect of that new interest rate. So it's not just gone up by 200 Rand, maybe it's gone up by 400 Rand or 500 Rand. So people thought this was weird. They were writing to me saying, but they increased my mortgage by 200 Rand and now they've increased it to 500 Rand. But the interest rates only went up once. And that's why it is. It's because you prorated in the first month, that when that interest rate was actually announced. And then obviously the second month, you've seen that full effect from day 1 to day 30 or day 31 coming through in the interest there. So that, I think, was just an interesting anomaly. I think, just to help people understand, no, the bank isn't charging you 2 interest rate increases. It's purely the way it's been prorated in the last few days of the month after the announcement from the NPC.
And so, it's important for people. I mean, it's good that people check their bank statements because, clearly banks can make mistakes. No system is perfect. But also equally, just understand then if this is happening to you, just check that. Just check that. If the announcement is made mid-month, which I think it usually is, that's going to happen. It's always going to be like that. And
Absolutely.
as you say, we've been a little bit spoilt in the last while with rates going down, so none of us would have complained too much. But now we need to know and focus on this. I thought maybe on the other side of the spectrum, a lot of people would be asking questions, which as you've also were saying before the show about, do I keep my interest rates flexible? Do I allow them to move up or down when the Reserve Bank is changing interest rates, or should I fix my interest rates on my debt? And it's a real question. It's quite comforting in a way to know that your rate is fixed, but I'm not sure that that's necessarily the best financial decision.
Warren, I get this question frequently, and interestingly, I had this question a lot. And people are getting very smart because they listen to us, Warren. They listen to all our shows and they're learning. And when we had those big drop in interest rates, obviously due with COVID, there was a massive cut in interest rates. Interest rates went down, I think, to one of the lowest ever in South African history. People saying, "Oh, is this a good time to fix my interest rate at this lower interest rate?" And the reality is that it's a little bit of a fool's paradise, because actually go to your bank and ask them what rate they'll fix at. And it's not the rate you're currently paying. It's usually about 200 points above what you're currently paying, because they're saying, well, if we're going to fix it for the next 2 years, for example, we're expecting interest rates to increase. So we're going to factor that in. So it's a bit crazy, because you could be paying a lower interest rate for another, and even in an increasing interest rate environment, you're not going straight to 200 percentage points, overnight. It's going to be incremental at 25 points, maybe 50 points every now and then. So really what happens when you fix interest rates is you start to pay more to the bank than you need to be paying for and basically taking a bet against the bank, saying, well, I think interest rates are going to go up higher than your calculations, which means you're pitting yourself against the bank's economists. And I've been looking, and I think there's only been 2 times in South Africa's history where interest rates increased above expectations. And certainly one was in 1998 when we had that emerging market crisis and the rand blew up and everything blew up. And I must just tell you, Warren, I bought my house then. And interest rates just after I bought my house went to 23%. 23%. People are crying now. I wrote an article about this. I said, for goodness, get over yourself. I've lived through 23%. And it was also again in 2001. You'll remember that again, the rand had that blowout. So, and I think rates went up by about 400 points there, which was a bit more than expected. But we're not seeing this time. I've spoken to the economists. They're all saying, in fact, our Reserve Bank has been managing this process extremely well, perhaps very too well. Some would say choking off a little bit of growth, but they're really staying ahead of inflation. We were raising interest rates well ahead of the rest of the world. It's very unlikely that inflation is going to get out of control to the extent that they'll have to do excessive hiking. So really, for me, Warren, people say it's peace of mind. It's an expensive peace of mind. I'll tell you how I get my peace of mind. I go and I always pay I pay usually more, but I won't pay less than 10% more on my mortgage. So say my mortgage repayment payment is 10,000 Rand. I will pay 11,000 Rand, an extra 1,000 Rand a month, every month, so that I know that if interest rates do go up, I can absorb them. They're in my budget. And of course, I get the advantage of paying off my capital a little bit quicker whilst during the period that interest rates are not rising. So for me, I think you can do it more effectively by simply building in a buffer on your monthly repayments, rather than going and giving the bank extra interest ahead of a rate increase. So I think for me, that's kind of the way I would go with it.
And it's such a power lesson, that, because it's, everything with money is always about, if you want certainty and you want to know where you're going, you need to take control. You need to be the one that drives the bus. And exactly, if you're in an environment where you have debt, I mean, we hate debt on honest money. So first call is pay off your debt as fast as you can. And if you're doing it by that extra 10%, that's brilliant. And I think also in an environment that we're in now, where interest rates are rising, make sure that you try and pay even a bit more, because if interest rates are going to cost you, if you were paying 7% on debt and now you're paying 9% and it might be 10%, it's really hard for you to guarantee growth on an investment of 10% a year. But debt is a guaranteed thing. You know exactly what the rate is. So pay it off as fast as you can. Maybe sort of lose a bit of focus on investments in a time like this where interest rates are rising and you've got debt. I would rather get the debt out of my life and then invest. But if you're going to do both, then maybe a little bit more emphasis on debt, a little bit less emphasis on saving for now, and get that debt out of your life. You just don't want a bank controlling what you do in your life, and the way they control you is when you owe them money. So I always think take control and get the debt out of your life. I think we're running out of time. Maya, these shows are always so interesting, and I've always got my favorite question, which I ask all our guests, and it's always a surprise, is if you had to meet your 21-year-old self now, and having learned all the life lessons that you've learned, what would be the one lesson you would want to teach yourself now?
Gosh, Warren, that's actually a very good question, because I look back. Yeah, so I think probably and it would be a financial one, would have been you don't buy that big house. But that's not so much a lesson, because I think I've been relatively good with stuff, but I did two things. One is I bought a London pie franchise with my retirement money when I left BJN. Actually, you'll remember those days. And I took that money and I bought a London pie franchise, which I should never have done. And I think most franchise businesses, there's a lot of sharks swimming in those seas. And I have calculated that probably, if I'd left that money invested, it would be about 600,000 today. So I'm feeling a little bit irritated about that. And I went off and I bought a big fixer-upper house when my second son was born, because for some unknown reason, I thought I needed a bigger garden, a bigger this and a bigger that, and what that cost us in terms of running costs, mortgages. So I think it is a little bit about, be reflective in your life, make some, think through your decisions a little bit more carefully. But I think we all make mistakes with money. I think it's what we do once we recognize the mistake and how we correct it that probably matters more.
Absolutely, and that is a powerful lesson. I mean, even someone who knows a heck of a lot about money is not immune and protected from those big decisions. And I think it's important to learn from them. And you're right. I mean, I think my best life lessons, especially around money, have been all the mistakes I've made. It's not I can't learn this stuff in a textbook. I have to learn it by hitting my head against the wall and then go, oh, that hurts. So I hear you. Maya, thanks so much for joining us on the show. It was I was going to use the dad joke and say it was really interesting, but it was really fascinating, and I appreciate your time and joining and sharing your information with us.
Great, thanks, Warren. Always good to chat.
Thank you for listening to Honest Money. If you have any questions, you're welcome to reach out to me on Twitter. My handle is @WarrenIngram. Don't forget to subscribe. We're on Spotify and Apple Podcast. Chat soon.